So as I said, in order for the residual income model to work, the clean surplus solution needs to hold. Okay? And the violations basically mean that items actually change in value on the balance sheet, but they don't flow through to the income statement. And that's then where we have a disconnect. So this equation that you see here actually will not work. Okay? So we need to kind of talk through what are the items that are included in the other comprehensive income. So remember, we have the income statement, the balance sheet, the statement of cash flows, and the statement of shareholders' equity. And in that statement, we look at linking the balance sheet values from one period to the next with net income and dividends being subtracted, but plus another column called other comprehensive income. Okay? And those four components of other comprehensive income are listed on this page. Basically saying that if a company has foreign subsidiaries, when you translate back over the assets and the liabilities and the income statement items to your domestic currency, you can have a currency translation gain or loss. So those incomes or those balance sheet assets and liabilities will come over. So those assets and liabilities change on the reporting domestic firm's balance sheet, but the gains or the losses associated with that do not flow through to the income statement. And as a result, you have a disconnect. Also, when you did your pension accounting adjustments to fair value or pension liability amounts, those actually will change in value and they don't flow through to the income statement. If you have unrecognized gains or losses on available for sale securities, remember available for sale are not like trading. Trading are operational assets, where available for sale mean that we're going to change the value on the balance sheet, but the gains or losses that are unrealized do not flow through to the income statement. Okay? And lastly, if you're using any kind of derivative instruments to protect your cash flows, any deferred gains or loss on those cash flow hedging instruments actually will change on the balance sheet, but again, don't flow through to the income statement. So all of these items are basically considered to be other comprehensive income that have to be used to reconcile the clean surplus solution that was violated when balance sheet items reflect fair value, but the income statement doesn't recognize those gains or losses. Okay? So the book value is essentially correct, but the net income, and therefore the ROE forecast that we have in the residual income model, is incorrect. So they've got a little note here to kind of help you out with this, that comprehensive income equals income under the clean surplus accounting. It actually corrects for all those disconnects between the balance sheet and the income statement. Other off-balance sheet items that we might need to make an adjustment as we go from a GAAP reported to a economic-based balance sheet. Remember, operating leases are different than capital leases. Capital leases are on the balance sheet. Operating leases are off the balance sheet. So basically, we have to take those minimum lease payments, present value, put an asset on the balance sheet and a liability, and amortize the liability and straight line depreciate the asset to have an apple-to-apple comparison. They are commitments to pay lease payments. They are financial liabilities. But under legal and accounting rules, they are not put on the balance sheet. We need to do that to make it more of an economic relationship that's true to what the firm actually needs to pay. Now, we could have off-balance sheet special purpose entities and variable interest entities that we might have to put on. We might have to convert a firm that's using LIFO inventory to current cost inventory by adding the LIFO reserve to the LIFO inventory balance on the balance sheet to get it up to FIFO inventory accounting, which is more current costs. And we also recognize that deferred tax liabilities that are increasing slowly over time, that are not reversing, really are not liabilities, but are equity positions. So we need to recategorize it within the income statement, or within the balance sheet. I'm sorry. You can take the DTL and move it over from liabilities to equity. And a deferred tax asset arises as a result of a tax loss carry forward. And if a firm isn't going to be profitable in the future and the valuation allowance isn't appropriate, then you can just take that DTA off the balance sheet, remove the earnings, the retained earnings on the other side, and bring it more into line to what you think the firm might be valued as. So again, the book value of the firm can be misstated. Now when we talk about non-recurring items, these are items that we want to exclude because they're not persistent. They're not part of the core normal operating earnings of the firm. So one of the examples is discontinued operations. That might only happen once every 5-10 years in a firm. Delete it, remove it, and get it off. It's not part of core and persistent, nor is accounting changes. So if a firm takes the economic useful life and goes from 10 years to 15 years, then what's going to happen is depreciation charge is going to drop, earnings are going to rise, and as a result, you have a one-time adjustment as a result. Now, all the future adjustments are going to be there, but it is a change or a non-recurring item that we want to remove. And remember, when a firm goes through restructuring, we make an accrual charge right off the bat, but it's non-cash. So we need to remove that as well, because it's basically a non-cash charge, and it's non-recurring. It's only for a certain period of time. Okay, so the implication for the residual income model is to only pick core, persistent, underlying earnings that are recurring over time and exclude the non-recurring items if you can. So it does take some perceptive analysis by the analyst. Some of the aggressive accounting practices that we need to be mindful of is the effect of, say, accelerating revenue to the current period. It kind of be like channel stuffing that Bausch and Lomb at one time used to do. You can actually defer expenses to a later period, which might actually be a method in order to make current profits better, but it makes future profitability less. Or you can use reserves to try to smooth your income. So, for instance, you can use your valuation allowance on your deferred tax asset to smooth income if you need to. You can adjust it for different periods. And so you can use these cookie jar reserves to try to make your income a little bit smoother. Again, we want to remove those practices, or at least look to see if a firm is doing that before we apply the residual income model. Now, the other thing, the last item that we needed to talk about is international accounting differences. All through financial statement analysis, they do the comparability between U.S. GAAP and IAS. So we just need to be aware of that there are some differences between one firm in one country and another firm in another country, and we need to be aware of these accounting differences. Are the earnings per share forecasts reliable? Is a clean surplus relationship being violated? Do the financial statements reflect economic reality? Just very good perceptive questions that the analyst should use before they get into the residual income model. Okay, so one of the questions that we need to work through is, for instance, it's a DCF problem, pretty straightforward. Which of the following is least accurate description of the similarities and the differences between residual income valuation relative to the DCF, the dividend discount model, in valuation terms? So, is the terminal value does not dominate the intrinsic value of the residual income? That sounds pretty good. The residual income valuation is acceptable for companies without dividends or positive cash flow. Or the residual income analyzes the accrual accounting concept of profitability, but DCF focuses on cash flow. Well, it would seem that C is probably the least accurate description. The first two are very accurate. C is probably not nearly quite as accurate. Market price. Wiz Park Restaurants has a market price-to-book ratio of 2.5. Current book value per share is €19. On an estimated ROE of 13 and a required return on equity of 11, if the market is in equilibrium, what is the growth rate implied by the market price? So essentially what we're trying to do is solve for the growth rate in the price-to-book model. And so if we work through that, you can actually work through the growth rate in the residual income model. And so remember, we had that kind of complicated example before where the price-to-book ratio times the book value per share will actually give you the market price that you put into the denominator, which is $47.50 in this case. So if you take the discount rate of 11 and subtract from it the book value times the spread, the $47.50 times a spread of 2%, divided by the difference between the $47.50 and the 19, you come up with a sustainable growth rate of 9.7%. Now the reason we threw this example in there is because it takes some perception and some work to do this, and you've seen two examples. Just get the hang of it. Just work through it a couple different times. So the last question is on valuation. Which of the following is least likely to cause inaccuracies in the use of the residual income model? Foreign currency translation adjustment, recognized gains or losses on available for sale securities, or a pension liability? Now just look very carefully at B. That might give us, because its violations are caused by inaccuracies due to unrecognized gains or losses. You see, it's the recognized. This is what is going to trip you up. It says recognized, and down here it's unrecognized gains or losses on available for sale securities. Okay? So yes, A is true and C is true, but B is not because it's unrecognized gains or losses. All right, so let's talk about the keys on the exam for the residual income model. You know it's very closely linked to the dividend discount model. They're just polar opposites of one another. And we do have a whole lot more emphasis in financial statement analysis. We start with a book value at time period 0, where we've converted it from GAAP to an economic balance sheet. We know that residual income is that economic profit that can be above or below accounting profit, but it takes an equity charge and removes it from GAAP reported income. And we had a general form of the residual income model, we had a single stage model, and a multi-stage model. And please be sure to be able to calculate and work through problems associated with the single stage and the multi-stage. And the multi-stage really did focus in on firms that had continuing residual income. And we went through an example where that persistence factor, omega, was 0 with pure competition, 1 with monopoly, some intermediate value, as in the example that we had of 0.6, where a firm has maybe a competitive advantage but has been diminished slowly over time. And the last case, where the price-to-book ratio relationship feeds in, and we have a firm that has a competitive advantage but slowly converges to the overall market price-to-book ratio of 1.1. Okay, kind of a reversion to the mean. Know that you can use the residual income model with firms that don't pay dividends, that may have negative free cash flows as a result of maybe an acquisition or a large capital expenditure, and it works pretty well as long as the firm meets the clean surplus solution. Otherwise, we need to go to our accounting and look at the other comprehensive income statement items to make the adjustment to get that clean surplus solution to become more readily accessible and walk through from one year to the next. So that's the residual income model. It's one of the more tested materials in recent years as they've gotten deeper and deeper into the curriculum. So please do work through the problems in the back of your readings. Work through all the questions that you have in the Schweizer material. They'll be very helpful as you work toward the exam in June. Good luck.